You're making payments on time, you're not maxing out your credit cards, but did you know that you probably have a habit that's killing your credit score? I'll break it down for you in this video. What's up, winners? My name is Nam. If you're new here, welcome. Here we talk all things personal finance and credit. Start out by subscribing so you don't miss out on any future videos. Today, we're gonna shed light on the silent assassin of credit scores. Credit utilization. You might be thinking, Nam, I heard this 1,000 times. Keep it under 30%, right? Well, hold on to your hats because there's way more to this than meets the eye. This topic goes deeper than just a percentage, and I'm about to unpack it for you. I've used this knowledge to maintain a high credit score, often in the high 700s or even 800s, depending on my credit activity throughout the year. So buckle up because we're about to dig deep. By the end of this video, you have a clear picture of what truly influences your credit. No stones will be left unturned, and you'll be well equipped to keep your credit score soaring. So let's get started. So you know how we always have that one friend that seems to get all the best deals? They get approved for loans in a snap, score the lowest interest rates, and even their insurance premiums are cheaper than ours. Ever wonder why? It just comes down to the credit score. Think of your credit score like a GPA for your financial life. It's the number that shows the banks and lenders how good you are with money. The higher your score, the better you look towards them. And trust me, you want to look good in their eyes. Let's take an example. Say that you and your friend apply for the same loan. You have a score of 650, which is not terrible, but your friend's score is sparkling at 760. Guess what? Your friend gets a loan at a lower interest rate, and over time, they'll end up paying way less than you, just because of that number. And it's just not about loans. Some employers peek at your credit score too, especially for jobs that involve handling money. And trust me, you don't want to lose out on your dream job because of this, right? So your credit score? Yeah, it's a big deal, but here's the kicker. There's a sneaky habit most of us have that's quietly sinking our credit scores. Alright, so before we dive deeper, let's clear up a few things. There are a ton of myths floating around credit scores. You probably heard some of them. Checking your credit score too often will hurt it. You need to carry a credit card balance to build credit, or all debt is bad debt. Sounds familiar, right? Well, they're not entirely true. First off, checking your credit score. Not only that it's okay, but it is smart. You can keep track of where you stand and catch any mistakes on your credit report. Trust me, it happens way more often than you would think. Free tools that I do recommend is Credit Karma and Experian. They are both free and you get access to your scores and reports. It's best to check all three every now and then just to make sure that your information is reported correctly on all of them. So if you want to see your scores and report all side by side, this is something usually you would have to pay for. So some tools I would recommend would be MyFICO or ScoreMaster. So second, carrying a balance on your credit card to build credit, that's a big no-no. What really matters is how responsibly you use your credit. And that means by paying off your balance in full every month if you can. Keeping a balance does not help with your score. It just costs you money in interest. And lastly, not all debt is bad. Yeah, you heard me right. Things like mortgages or student loans can actually help your credit score if you're making your payments on time. These types of loans affect your credit differently. It shows lenders that you can handle and repay borrowed money. But here's the thing, even if you're doing all of this right, you could still be hurting your credit score without even knowing. So you're probably sitting there thinking, I pay my bills on time, I don't max out my credit cards, I'm good, right? Well, not so fast. There's this habit, a lot of us have it, and it's silently chipping away at our credit scores. And that habit is only paying the statement balance whenever it becomes due. You're probably like, nah, isn't this what I'm supposed to do? Pay my bills on time? Yes, you are, but paying your bills in this particular manner is killing your credit score. Okay, I'll give you a real example so it's easier to follow. Let's just say that you have one credit card and your credit limit is $5,000. You decide to buy airline tickets, Coachella tickets, and your Airbnb reservation, which all comes down to $3,000. Now you just go about living your life and wait until you receive the credit card statement via mail or whenever you get an email from your bank saying that the statement is ready to be viewed. So whenever you view that statement, you just pay whatever statement balance is due. Technically, you pay that statement in full. Now, this is not terrible at all since you are paying your debts on time. If you were to be late to any of them, this can add additional fees and potentially make your credit score worse. But this is how you can do better. By the time you receive your credit card statement, it's too late and your credit score is already affected. Meaning that whenever you receive a statement balance, that amount will already be reported to the credit bureaus. Meaning that if you were to spend $3,000 that month, the following month, that information would already be affecting your credit score. So in this specific example, if you have a $300 credit card statement with a credit card that has a credit limit of $5,000, this means that in this particular credit card that you will have a credit utilization of 60%, which is pretty bad. The golden standard is 30% or less, but I prefer for you to keep your credit utilization under 10%. So the other question that you may be thinking is that, does this mean that I only could use 30% of my $5,000 or even only 10%? I need to spend way more money than that. I get why you may think this, but your credit utilization only matters by the balance that's left before the statement closing date. Now, every credit card that you open will have a closing date. Sometimes this is referred to the account closing date or billing cycle end date. This is the day when your credit card issuer generates a monthly statement issuing all of the transactions that you made during that billing cycle or time frame. So for simplicity's sake, if your billing cycle is between June 1st and June 30th, you need to keep your credit card balance as low as possible before June 30th. Because once it becomes July 1st, that cycle ends and whatever balance is left over gets reported to the credit bureaus. To keep that balance as low as possible prior to the closing date is just to make early payments. Now let's go even further on utilization. Another thing that you can do is spread your purchases across multiple cards. The amounts owed portion of your credit score is more than the credit utilization on a single credit card, but it's also the balances across all of your cards. I get that you may favor one card due to convenience or rewards, but if you are a person that prefers to pay the balance when it becomes due, then having utilization even out across multiple cards is much better than having it all on one card. And finally, consider increasing your credit limit. But listen, this isn't an excuse to spend more. It's just a way to lower your credit utilization ratio. So if you were to go this route, just make sure that you're sticking to the same spending habits. Additionally, asking for an increase usually will result in a hard inquiry. So your credit will be affected in the short term, but your credit score will thank you in the long term if you keep the same spending habits. Remember, the goal here is to show lenders that you're not heavily reliant on your credit. And with these tips, you can do just that. All right, so maybe you're watching this and you're thinking, great, I've been doing this all wrong. Now my credit score is in the dumps. But hey, don't stress. You can turn this around. The first thing that you need to do is reduce your balances. This may take some time and a lot of discipline, but it is the most effective way to lower your credit utilization and improve your score. Next is to keep your credit card accounts open even if you're not using them. Closing an account reduces your overall available credit and can increase your credit utilization ratio, which can hurt your score. As a side note, reducing overall available credit only hurts your score if you are a person that continues to keep balances on your credit cards. If you have a zero balance, it does not matter if you have a $1,000 or a $100,000 credit limit. It just gives you more leeway in case there is a balance when the billing cycle ends. You should also consider setting up automatic payments to make sure that you're paying your bills on time. More specifically is if you can pay your balance prior to the statement closing. Not all credit card issuers allow this, so just double check with yours if it is a possibility. And lastly, be patient. Your credit score won't jump up overnight. To apply this technique correctly, you will first have to make sure that you pay the statement balance due and your current balance. For instance, you may receive a statement saying that you owe $1,000 and it must be paid 21 days later. In the meantime, you were still using that credit card for regular expenses, so your current balance is $1,500. To get the best of both worlds is by paying off your current balance prior to the payment due date and before the billing cycle ends. This way, you pay the amount that you have to pay, plus you have a lower balance reported to the credit bureaus. If you do this correctly, you should see your credit score jump the following month. Now, I know that this was a lot to take in, so let's take a moment to answer some of the most common questions that you may have about credit scores and credit utilization. First up is that if I pay off my balance in full every month, why does my credit utilization matter? Remember, your credit card company reports your balance on your closing date, not your payment due date. So if you have a high balance on your closing date, that's what gets reported, even if you pay it off in full later. And next is, can I improve my credit score quickly while lowering my credit utilization? The answer is, it depends. Credit utilization is a significant factor in your credit score, so lowering it does help. But remember that it's just one piece of the puzzle. Your payment history, your age of credit, and other types of credit that you have also plays a role. Understanding your credit score and how to manage it, it's a skill in itself. And with these tips and insights, you're well on your way to a better credit score. If you have any questions about credit utilization whatsoever, let me know in the comments and I'll try to answer as many as I possibly can. And if you want to hang out with me some more and learn more about credit, come check out these videos over here.